Good afternoon. Good afternoon, everybody, and welcome. Let's hear it for Wayne County's diverse, dynamic, and driven businesses that were just featured in Made in Wayne 2.0. We always love the opportunity to tout and brag about all the cool stuff that's made in Wayne County. And we welcome you today. We're really excited to have this great turnout on a beautiful day when some of you could be on the golf course. So we're glad that you made your decision to come here instead. I'm Mary Beth Burns, the president of the Wayne Economic Development Council, and on behalf of our team, we say thank you for coming today. And thank you to President Mester for gracing us today with your comments. This is a B4B, a Briefings for Business, and the WEDC holds these quarterly. It's a great opportunity for the business community to get together and network and learn something about topics that are relevant to our business community. We appreciate your participation, and we welcome our guests from outside of Wayne County to Wayne County today and appreciate your attendance and partnership. We were really thrilled and excited. For the first time in my memory, our economic development partners locally have joined us for this B4B planning, and we appreciate their attendance and their participation. We're very excited and thrilled every day to get to work with such wonderful, talented economic developers. So I want to just take a brief minute to introduce those folks to you. First, Cameo Carey from Grow Ashland. You can give a wave or stand up. Mark Leninger from, there you are, Mark, it's nice to see you, from Holmes County Economic Development Council. Bethany Dentler from Medina County Economic Development Corporation. Hey, Bethany. I would be remiss if I didn't say Bethany has been awesome since day one in helping me in my role at WEDC. So I really appreciate Medina County and Kimberly as well. Kimberly Marshall from the city of Medina, very helpful. Appreciate that. And then lastly, Ray Hexamer, who's also been extremely helpful to WEDC from the Stark Economic Development Board. Thank you. I keep remembering that the last time I was up here for our annual meeting, my mother saw the photos and said, "You didn't smile once, you looked very grouchy." So I'm going to try to make myself smile every now and then. I believe we also have representatives from our regional partner, Team NEO. I don't quite know where you guys are sitting, but Sean, Kendra, and Abigail, there you are. Thanks for coming today, appreciate that, and appreciate all the support that you provide to our local economic development organizations. I am proud to be working among such talented people who are all dedicated to making great things happen in our respective communities. We also want to thank our event sponsors today. We appreciate the generous support from what we're calling our groundbreaking sponsors, Edward Jones and the 6 advisors from Edward Jones, Medina, and Wayne County. Thank you. And we thank you for bringing guests, one of which was a longtime coworker of mine, Larry Herman from Smucker's, years and years ago. It was so nice to see Larry. I hadn't seen you in, 10 years. Can't wait to catch up. Cocktail after this, Larry. We also want to thank our sponsors of our events throughout the year, that MCTV, Magnet, and Ohio Means Jobs, Wayne County. And lastly, we want to thank the Wayne County Schools Career Center, LightSource BP, and Westfield Bank for sponsoring what Tracy has called our Sprouting Leaders tables, which I sometimes call just students, but Sprouting Leaders sounded way more creative. We appreciate the University of Akron students that are here. We've got some College of Worcester students and the Career Center students, and we really appreciate you being here. It's a great opportunity for you to mingle, and as you saw, we have great jobs available in Wayne County, so we want to keep your talented folks here, and you folks from University of Akron are not allowed to leave the county. One housekeeping item, there are note cards on your table, and those are for you to jot down any questions that you might have for President Mester. Tracy and Caro will be collecting those, and we look forward to you asking whatever questions come to mind. Now it's my pleasure to welcome Eddie Steiner to introduce our keynote speaker. Eddie is a member of the WEDC board and executive committee. But equally important, he's also the president and CEO of the Commercial and Savings Bank and a director of the Federal Reserve Bank of Cleveland. Eddie was obviously very instrumental in getting our speaker secured today, and we appreciate Eddie's contribution with that. With no further ado, it's my pleasure to introduce Eddie Steiner.
Thank you, Mary Beth. And Steve Matthew was teasing me, or Adam, one of the two, about being a stickler for details. I'm going to be a stickler for details. At CSB Bancorp, the holding company, we own the Commercial and Savings Bank, and Brett Gallion is actually our president. I'm CEO, so stickler for details there, note to self. But I will say it is my pleasure and my honor to introduce our speaker, Loretta Mester, President and CEO of the Federal Reserve Bank of Cleveland. In her role, she participates in the formulation of U.S. monetary policy and oversees more than 1,000 employees at the bank in Cleveland, its headquarters, the district headquarters, and also Pittsburgh and Cincinnati. President Mester is a trained and practitioner economist, I would say. She has a PhD in economics from Princeton University. Besides her work on behalf of the Fed, she is active on many civic and nonprofit boards, and those include the Greater Cleveland Partnership, the Cleveland Orchestra, and the Cleveland Clinic. She is a frequent and sought-after voice on matters related to the economy and monetary policy, and many of you have likely seen her being interviewed on Bloomberg or CNBC or other national or global media on various occasions. While I have known President Mester for the full 10 years since she arrived, I was on an advisory council at the time she came, I have had the privilege since 2019 of seeing her in continuous action as a member of the board at the Federal Reserve Bank of Cleveland. And I want you to know that in my business career, I have yet to interact with any other individual more genuinely interested and wholly, constantly engaged in understanding the dynamics at play affecting the economy as a whole, but beyond that, the economic well-being of individuals, households, businesses, and organizations. She just doesn't quit. It's an intellectual curiosity driven by something that just makes her engage, and that is one of her outstanding features. You will find President Mester is a very engaging conversationalist. She likes questions. There's going to be a Q&A afterwards. She really does. So I would encourage you to be listening closely to what she said, and also not just from her prepared remarks, but to ask what's on your mind. I am confident you will find that her insights and perspectives are meaningful to you, to organizations that you're representing, both her prepared remarks and when we ask her the questions later on. But please join me in a warm welcome for President Loretta Mester.
Well, thank you, Eddie, for that. That was very nice. And also thank the Wayne Economic Development Council for inviting me to speak on the economy and monetary policy in this Briefings for Business series. You know, when I think about what your council's work is about, it's to foster economic development in the region. And that really aligns very well with the Federal Reserve's mission to foster a strong economy. So I'm particularly happy to be here today. Now, as you know, Eddie Steiner is an active member of our board of directors. He's also the chair of our board's audit committee, and as he says, you know, this is important work that we do on behalf of the country, and we couldn't do it without board members like Eddie Steiner, so I really appreciate that. Steve Matthew is going to be moderating the Q&A portion of today's session, and he is an active member of our Northeast Ohio Business Advisory Council. And I really want to take the opportunity to thank both Steve and Eddie for all their contributions that they're making on behalf of our bank. We could not fulfill our mission without their help. And I also want to thank the many others in this room. You all regularly provide us with economic information that's really crucial to our understanding of what's happening in the economy. And if you look at the Beige Book, which is the publication that the Federal Reserve publishes a couple of weeks before each Monetary Policy Committee meeting, you'll find that we summarize the information we've gleaned from our district in that book. And that really helps us understand what's going on in businesses, the labor market, communities, and financial markets. And it really is really important information. We do get a lot of data. Everyone can gather economic data. The government puts out statistics. We gather our own data as well in some of our own surveys. But a lot of times that data tells you about where the economy is or where it's been. The information that we're getting from all our contacts throughout the district really tell us about a good idea of where the economy is going. It really helps us discern the future a little bit about where the economy, how it's evolving. So that's really important for monetary policy making. So the people who are providing us with information, and I want to thank the many people in this room and who are listening in for doing that work for us, you are playing an important role in the making of monetary policy. It really helps inform my own views about where the economy is going, the outlook for the economy, and what I should be doing as a monetary policymaker. And I bring that information with me to FOMC meetings, and I share it with other policymakers so they also can understand what we're seeing here in our region of the economy. So thank you very much for that. I really do appreciate that effort because you're all very busy in your own companies and your own businesses and your own communities, but you're doing this on behalf of the public, and I really appreciate that. So as Eddie said, I'm really looking forward to the Q&A portion of this speaking engagement. I really learn a lot from what I hear on people's minds. It does help inform my views on the economy. So I really do hope that you'll use the cards on your table to put in some questions, and I'll do my best to try to answer them and give you my views on those topics. But before we get into that portion and that dialogue, I thought it would be really helpful to frame the discussion by offering some remarks about the economy and monetary policy. And I must say, the views I present today will be my own and not necessarily those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So the FOMC met about 2 weeks ago, and at that meeting, the committee decided to maintain the target range for the federal funds rate, which is our policy rate, at 5.25% to 5.5%, and to continue to reduce the Federal Reserve security holdings. And we've held our policy rate at that restricted level since July of last year. Now, the FOMC reiterated that it doesn't expect it will be appropriate to reduce the target range until the committee has gained greater confidence that inflation is moving sustainably toward our goal of 2%. Now, if you step back, substantial progress has been made on the inflation front since inflation peaked in 2022. And remember, it peaked in a range of 7% to 9%, depending on the measure that one looked at. In the second half of last year, inflation readings came in lower than expected, and PCE inflation was running at about 2%, or at our 2% goal over those 6 months of the year. But the year-over-year measures of inflation remained elevated, and we on the FOMC knew it was too soon to declare victory over inflation. Now, over the first 3 months of this year, we have seen no further progress on PCE inflation. In fact, measured year-over-year headline PCE inflation moved up to 2.7% in March, and core PCE inflation remained at 2.8%. And if you look at the 3-month changes, they're running considerably above the levels seen over the second half of last year. Over the past 3 months, PCE inflation in core goods and PCE inflation in core services, excluding housing, have moved up, and housing services inflation has moved sideways. Now, we did get a CPI inflation report yesterday. That's the first inflation report we have for the month of April. And we saw a welcome tick down in the monthly readings for total and core CPI inflation. But those readings were higher than those we saw in the second half of last year. Now, I had expected the progress on inflation to slow this year compared to last year because I didn't think we'd get as much help from the supply side adjustments that we got last year. Supply chain disruptions and bottlenecks have really improved over the past 3 years, and the labor market has been normalizing. So people have returned to the labor force over time, and immigration has also increased the supply of labor. So that healing of the supply side of the economy contributed to last year's disinflation, and I don't think we're likely to get as much help on inflation from the supply side this year as we saw last year. Progress will depend more on moderating demand. Still, the lack of progress on inflation so far this year has been disappointing. I do think it's too early to conclude that progress on inflation has stalled out or that inflation is poised to reverse course. You know, we knew that the journey back to price stability was never going to follow a smooth path, but the recent readings have not inspired greater confidence in me, and we're going to just need to accumulate further data over the coming months to have a clearer picture of the inflation outlook. I now believe it's going to take longer to reach our 2% goal than I had previously thought, but, and I want to say this very emphatically, the Fed remains strongly committed to returning the economy to price stability. Now, the good news is that the economy is well positioned to allow us to accumulate those data without concern that monetary policy is overly restrictive. A really remarkable thing about last year's disinflation is that it occurred in the midst of strong economic growth and labor markets. Last year, the economy grew at a pace above 3%, which is higher than my 2% estimate of trend growth. And indicators point to continued upward underlying momentum in the economy this year. According to the advanced estimate, GDP growth did moderate to a 1.6% pace in the first quarter, but that step down reflected the inventory and trade components, and those components are often revised in subsequent releases as more data come in. If you look at final sales to private domestic purchases, so think about, that's a pretty good indicator of underlying demand, that continued to rise at a pace of around 3%, so that's pretty good growth. Consumer spending has remained healthy, although we have seen rising credit card delinquencies. And business fixed investment in equipment and software has strengthened, which is consistent with the anecdotal evidence that we're getting from our business contacts. Indeed, leading up to the FOMC meeting 2 weeks ago, there was a significant change in tone from the contacts in our district. Many reported that economic activity had strengthened, and by more than they had anticipated over that period. Labor market conditions also remain strong. Payroll job growth really has been remarkably resilient. Job gains averaged about 270,000 per month in the first quarter of this year, compared to 210,000 per month in the previous quarter. Now, we did see a moderation in employment last month, but it's still a healthy gain of 175,000 last month. The unemployment rate remains low. It's 3.9% as of April. And even with those strong numbers, we have seen some better balance coming into the labor market. You know, demand for workers has moderated, supply of workers has increased. And the gap between the number of open jobs and the number of unemployed workers has narrowed over time. In fact, it's now about 1.3, so 1.3 jobs per unemployed. And that's only slightly above the 1.2 level that we saw in 2019, which was also another period of strong labor market conditions. And when you talk to regional contacts, they tell us that it does remain difficult to find candidates with the skills needed for certain jobs, but in general, they also tell us that it has become easier to hire over time, and that's that moderation that we're looking for. Now, as labor demand has come into better balance with labor supply, wage pressures have eased. So firms in our district, right, are now expecting wage increases to average about 4% this year, but last year they were expecting them to be 5%. So that's a moderation. And if you look at the wage premium, right, what can you get from switching jobs compared to staying in your job, in your current job? That's moved back down to levels that are about where they were pre-pandemic. So another sign that there's been some, better balance in the labor market. That level had shot up during the pandemic, and right after the pandemic, when the labor markets were open again, the economy was open again, and people were really being bid away from their current jobs because firms just really needed to have workers. Now, the question always comes up like, well, is that wage growth inflationary or not? And, whether wage growth adds to price pressures depends on whether wages are adjusted for inflation, so real wages, are growing faster than the growth in labor productivity. Now, if you look at current estimates of trend productivity growth, right, they're in the 1 to 1.5% range. So wage growth is still above the level consistent with 2% inflation at that level of trend productivity growth. But there is a possibility that changes in technology are going to lead to higher trend productivity growth. If you think about the scarcity of workers during the pandemic, we heard from many, many firms that, they had this great incentive to automate and they were doing so. And then there's new technologies such as generative AI. They do hold the promise of increasing productivity over the medium to longer run. So if it's true that there's going to be higher productivity growth and that those high numbers that we got last year, if they're sustained, then it could be that current levels of wage growth could continue without adding to price pressures. However, if the estimates of productivity growth that we've had over time, the 1 to 1.5, then we'll still need to see some moderation in wage growth. Now, when you think about our regional economy, the current developments in activity, employment, and inflation at the national level, we're also seeing them in Ohio's economy. And, as in the nation, labor market conditions in the state remain strong, but we have seen signs of them moderating, which is a good thing. The state's unemployment rate has ticked up this year, but it stands at 3.8% in March, and that just is it's near its historical low, so that's a strong indicator. Employment growth over the first 3 months of the year has slowed from last year's strong pace, and that's another sign of moderation, still healthy but moderating. And as I mentioned, employers in the state are telling us that it's now easier to hire than it was. Now, immigration has likely helped ease some of that labor market tightness. Last year, immigration was the main driver of an increase in Ohio's population, which was the first yearly rise in population since the pandemic. So all in all, we have seen strong labor market performance in the state, just as we've seen it at the national level. Now, Ohio is the 7th largest economy in the nation in terms of gross state product. Manufacturing and within manufacturing, auto and auto parts constitute an important sector of Ohio's economy. And compared to the nation, manufacturing still represents a larger share of payroll jobs in Ohio. But if you look over time, that differential has fallen as the economy here is diversified from one largely dependent on manufacturing and heavy industry to one in which healthcare and education play a more significant role. So if you think back to the 1990s, manufacturing represented about 20% of Ohio's jobs, and eds and meds represented about 12%. Those shares have now basically reversed. In the past decade, the share of jobs in manufacturing has fallen to under 13%, and the share in eds and meds has risen to nearly 17%. So we see this transformation over time in our economy. Now, the good thing is that regions that have diversified their industrial base have generally fared better over time and have proven to be more resilient. When a shock hits the economy, they've been able to bounce back better than other regions that are more heavily in one industry or another. But of course, the type of shock that hits the economy matters for that, right? It can, that type of shock can have differential impacts on regions depending on what their industrial mix looks like. So, for example, if you think back to the pandemic, healthcare was hit particularly hard. And the labor market in healthcare remains particularly tight, with nurses expected to remain in short supply for some time to come. But the good news here is that even within healthcare, our contacts are reporting to us that they have seen some improvement in hiring and some normalizing in wage growth. So again, the trends we're seeing in the nation are being seen in our own regional economy as well. So what about the outlook? So in my view, the most likely scenario for the overall economy is that, and that of our region as well, is that the current restrictive stance of monetary policy will continue to help moderate growth in labor market conditions, and this moderation will contribute to further easing of price pressures. So I do expect progress on inflation over time, but at a slower pace than we saw last year. And there's some research that supports that view. Analysis at the Cleveland Fed indicates that if you look at the past slowdown in wage growth that we've seen, that's going to pass through to lower price inflation in core services, and that the declines that have occurred in rents in new leases will pass through to slower inflation in housing services. But both of those effects are going to be needed for us to get back to 2% inflation, and both of those effects will take some time. So setting monetary policy in this environment is going to take careful consideration of the risk to both parts of our dual mandate as the economy evolves. And our dual mandate, of course, is maximum employment and price stability. So recent data showing strong growth and labor market indicators suggest that risks to the employment part of our mandate have diminished. But the recent inflation readings suggest that risks to the inflation part of our mandate have risen. So I'm going to be particularly attuned to the upside risk to inflation. And there are a couple of them. Geopolitical tensions have the potential to further raise oil prices and other commodity prices or to disrupt supply chains. The shortage of housing could keep housing services inflation elevated, even though rents have been falling. Medium and longer term inflation expectations are important determinants of actual inflation, and those expectations have remained reasonably well anchored at levels consistent with our 2% inflation goal throughout the high inflation episode. So that was a benefit, because that anchoring was really an important contributor to the disinflation we've seen over time. But if you look at the recent readings, at least on short-term inflation expectations, they've moved up again as the inflation readings have moved up. And if that increase in short-term expectation were to spread to medium and longer-term expectations, it would be considerably harder to reach our goal of 2%. So setting monetary policy to ensure that those expectations remain well anchored will be very important. So the FOMC's job continues to be to assess the implications of economic and financial developments for the outlook and the risks around the outlook, and given that assessment, to calibrate monetary policy so that inflation returns sustainably to our 2% goal and labor markets remain healthy. Now, the actual path monetary policy takes will depend on how the economy actually evolves. And this is that data dependence that policymakers often refer to. But our current policy stance puts us in a really good position for managing the risks that could be realized. In my view, moving rates down too soon or too quickly without sufficient evidence to give us confidence that inflation is on a sustainable and timely path back to 2% would risk undoing the progress we have made on inflation. And with labor markets and economic growth both being very solid, we don't need to take that risk. Incoming economic information indicates that it's going to take longer to gain that confidence, so holding our restrictive stance for longer is prudent at this point as we gain clarity about the path of inflation. Now, once the FOMC does gain confidence that inflation is moving sustainably back to 2%, it will be in a position to begin to gradually normalize policy back to a neutral level as the economy returns to price stability and maximum employment. Now, it's not my base case, and I want to emphasize this, it's not my base case, but should developments in inflation and inflation expectations warrant it, policymakers will need to be open to tightening policy further. On the other hand, if the labor market unexpectedly deteriorates, again, not my base case, But in that case, policy could ease sooner and by more than currently anticipated. So monetary policy is really well positioned for risk management as we gather more evidence on how the economy is evolving. So the FOMC remains fully committed to returning inflation to our 2% goal because price stability is critical for the long-run health of the labor market, the overall economy, and the stability of the financial system. And as we've seen since the pandemic, high inflation can badly affect people's lives and their view of the country's economic well-being. So at a recent Business Advisory Council meeting that Steve participated in fact, I think he led this discussion, we discussed the fact that even though the labor market is strong and inflation is down from its peak, many people are not very happy about the economy. And if you look at measures of consumer sentiment and consumer confidence, they're well below their pre-pandemic levels. So I believe dissatisfaction with the economy partly reflects the fact that even though inflation has been coming down and wage gains have been relatively high for some people, prices for many things are still higher than they were before the pandemic, and many people's wages haven't really kept up with inflation. So when inflation persists at levels above our goal of price stability, the price level, that overall price level in the economy, is moving up faster than we'd like, and households and businesses have to pay those higher than desired prices. Now, the good news is that as inflation has been moving down, wages adjusted for inflation, real wages, have begun to move up. And as that disinflation process continues, it's going to help close the gap between the cumulative increases in prices that we've seen over this period and the cumulative increase in wages. So as that gap closes, I think people will then begin to feel that they've made up for lost ground. Now, the other factor I think why people aren't that happy with the economy is that it's much harder to purchase a house than it used to be. So the median price of a home in the US is now almost 50% higher than it was prior to the pandemic. If you look at the 30-year mortgage rate, they're now over 7%. Prior to the pandemic, they were under 4%. And if you look at a recent study of consumers that the New York Fed fielded, they found that renters believe that the probability of their ever owning a house, is now falling to 40%. And that's the lowest level since the question was first asked in 2015. And as everybody in this room knows, owning a house is really an important avenue for building wealth. But many people feel this part of the American dream is out of reach, at least for now. And that's just not a good feeling. So I'm hopeful, though, that the economy will evolve as expected. And as inflation returns to our target, we return to price stability. As economic conditions continue to normalize, and as the labor market remains healthy throughout, then more people will be able to enjoy the benefits of what a strong U.S. economy has to offer. So thank you for listening. That concludes my prepared remarks, and I'm really looking forward to our discussion. Thanks.
Well, Loretta, thank you for taking time for a Q&A. I want to let everybody in the room know that when Loretta was appointed to lead the 4th District, we literally hit the jackpot. And to reinforce what Eddie says, extraordinarily thoughtful. I leave a meeting with Loretta and her staff, and I just think, regardless of all the noise and the news and whatnot, we have steady leadership, and I thank you for that. So I know there'll be a lot of good questions because we have a thoughtful crowd here today. So I'm looking forward to the questions. Mike will gather the questions and bring them up. So we'll start.
Thanks.
And by the way, when I see Loretta on CNBC or in the news at all, I admit that I'm a fanboy. So.
Thanks. I need.
Yeah.
It's good.
Okay. Question number 1. In your speech, you talked about information that your business contacts have provided you. Can you tell us more about how you collect that information and how you relay it to other Fed officials when you meet in Washington?
Okay, good question. So the Cleveland Fed I think, does an excellent job of gathering this information. And we do it in a number of ways. We have 8 business advisory councils, and they're across the district. So our district is all of Ohio. It's part of Kentucky. It's part of Pennsylvania, and it's part of West Virginia. So we're trying to really gather information from the complete district. And as I said, a lot of that information finds its way into the Beige Book, which is that publication that kind of looks at the regional economies before every FOMC meeting. In addition, we have a community advisory council, so that council really helps us understand what's happening at the grassroots level in communities in our district. We have a CDAC, which is a community depository, and Eddie was on that, Depository Institution Advisory Council. And so that's another way we gain information, because banks are really a good source of information. You know, we have bankers on our board. By statute, we have to have bankers on our board, but they're really a good conduit of what's really happening because they're really in touch with their customers. We also have a Diversity and Inclusion Advisory Council, which helps us understand some of those issues that are affecting our district and businesses and hiring. So there's just a lot of information that we gather through these touch points that we have throughout the district. We have an Energy Advisory Council, I guess we're calling it a roundtable, where we're really trying to understand what's happening in the energy sector, which is important for parts of our district. So again, we do that in person kind of talking, whether it's in person or online, but it's interacting with individuals. Then we field a number of surveys, and a lot of people in this room, I'm sure someone in your firm is filling out a survey for us. And that information is great because what happens is our research staff take the answers and they develop what we call diffusion indices. And the kinds of questions are, has activity increased over the past 6 weeks or decreased? And then we can sort of analyze, well, what % of our respondents are seeing increases versus decreases? And those kind of diffusion indices actually are informative about the future. So there's a number of touch points. I like going out and talking to people in these kind of venues too, because I learn a lot from the questions about what I should be focusing in on. Oh, I hadn't really thought of that as being a big issue. Now I have to think about that a little bit. So there's a whole bunch of avenues that we try to make sure that we're really in touch with what's going on the ground, because one of the things I said in this speech is really true. That information is really forward-looking for us, and that's really important. And then when I go to FOMC meetings, you know, we all sit around the table and talk about the economy. I always make a point. I structure my comments, and you can go, I think some of mine now are public for FOMC transcripts. I always structure by first talking about the district economy. What am I seeing in the district? Then I say, okay, and here's how I'm viewing the national economy, and I try to relate the two. And then I talk about policy in part of the meeting as well. So I'm trying to make sure that I'm a good representative of the 4th District at that table, and that information is actually important for setting monetary policy.
Yeah, and I would say that Loretta and her entire staff, they don't just hear us, they actually listen, and there is a difference. And I've never left a meeting that I didn't feel that there was a lot of thoughtful listening going on, and I know that we're well represented, so thank you for that. Question 2. Will the increased onshoring of manufacturing and the subsequent increase in manufacturing jobs add additional inflationary pressure?
Well, I think those things happen over time. So I'm not concerned about that as being inflationary in the current environment. I think that kind of onshoring is part of the economic environment in which monetary policy has to take account, right? But it's not like a near-term risk to the inflation outlook at this particular time. I do think, you know, there's a whole interesting thing going on in terms of underlying structure in the economy, whether it be supply chain issues that we faced, people feeling that they need to make their supply chains more resilient. There's, you know, national defense reasons where you might want to encourage more manufacturing to be onshored versus offshore. And then there's also the infrastructure spending. When all those things happen, they're important parts of the economic environment that will feed into what your outlook is for the economy. Some are longer term issues that we're going to have to think about. Some are shorter run issues. But the onshoring per se is not something that in the current inflationary environment is one of the factors that's a main driver.
Next question. What do you think the impact will be from the latest imposed tariffs by the current administration?
But again, I think of this as being something that, the Fed, as monetary policymakers, we take into account what's happening on the fiscal side of the economy, what's happening on other policy that will affect the economy. And that's the way, that's the way we approach those kind of decisions. It's part of the economic environment, just similarly to what we do about foreign economies, what's happening in other countries. Oh, thank you. Mine's open too, but thank you.
Question number three, excuse me. What are the implications of decentralized cryptocurrency on our country's economic future? Wow, that's a loaded question.
Okay. All right. So there's a lot of work going on within the Fed to understand the issues that are posed by an alternative payment system that doesn't run through or store wealth, whatever you think crypto is, because different people have different views about it, versus a national currency. And so there is work going on in the Fed to understand the implications for the transmission of monetary policy, for payments, for other aspects in terms of bank regulation, financial stability. No decision has been made about a central bank digital currency or anything like that, but we're doing work to sort of understand those issues. And we're also doing work to understand the technologies, because some of the distributed ledger technologies are going to be useful for the Fed payments as well, not just for cryptocurrency payments. So there is a lot of work going on, but there's no decision being made about central bank digital currencies. And we wouldn't make a decision, the Fed wouldn't make a decision without it being sort of vetted in Congress, and Congress telling us that this is something that we wanted to do in the administration as well. So.
Thank goodness, because I can't even spell cryptocurrency, so it's good. With our national debt growing at a rapid pace, nearly $1 trillion every 100 days, should we be fearful of what awaits us in the next 10 to 20 years?
I do think that it's important for the country to get fiscal situation on a sustainable path. I don't believe it's on a sustainable path now, and there'll have to be work that is done to sort of balance things, right? So it's probably going to be a combination of taxes, spending, revenue growth. But I think eventually we're going to need to actually take that seriously and get it on a sustainable path. Is it an immediate issue right now? No, because we have Treasury securities that are very much in demand across the world. But I think for the health of the country, we need to get that on a sustainable path going forward.
This is an election year.
Is it?
Did you believe that? It's unbelievable. I wouldn't have known. How does the Fed navigate this period when moves might be seen as when the election might be seen as influencing the outcome in November, or when the moves of the Fed might influence the outcome?
Yeah. So I get this question a lot, and I can tell you, I've been going to FOMC meetings since 2000, because I was a research director and I got to go to FOMC meetings when I was a research director. And I honestly can tell you that politics does not enter that room at all, right? We don't talk about it, we don't discuss it. We really are focused on what's the best monetary policy to achieve our dual mandate goals of maximum employment and price stability. You know, we try to live up to that every day, and I think the integrity of the Fed is really what protects us, by always trying to be objective, good actors in terms of making sure that we explain our policies, explain why we make the decisions we make. That's why I think central bank communications are really important, because we have to live up to the trust that the American people puts in us. But I honestly, that doesn't come into the room.
Thank you. As electric vehicles become ever larger percentage of the national fleet, how might the corresponding decline in petroleum consumption impact the U.S. economy and employment?
So it's a good question. But I think of it a little bit differently in terms of, right, there's going to be opportunities. And whenever there's been a shift in technology, and I think of this as almost like a shift in technology, right, there's opportunities, right? So it's going to take a long time for that transition to happen. I think some people thought it would happen quicker than when you actually look at the data that says, well, we're not going to transition as quickly as we might have thought. But those transitions are true about a lot of industries that might have been the industry to be in, and then another industry, rises up. I mean, you can think about over time when that happens. This is another opportunity, the way I look at it.
Yeah, good. So this comes from Team Neo, our friends at Team Neo. What strategies can Northeast Ohio implement to address demographic challenges coming to a head? Stagnant, decreasing population, and aging population. That's a big question.
Well, yeah, I was looking at these population statistics because, of course, we know that immigration was higher than people had anticipated it being over the last couple of years. And it is true, like in Ohio, we are aging. Natural births and deaths, right, last year were still not a contributor to growth. It was really mainly immigration and a little bit of domestic migration to the state. So that isn't a challenge because we know that, you know, regions' health, right, depend on having a vibrant labor force, having more people join. I think one of the big important things, and I do believe it's going on, is keeping the students who are here in the region, right? We have great universities in Ohio, very good universities. They attract people not only from Ohio, but outside of the state. We should keep those great minds here in Ohio. And if we can do that, right, and we can train the people who are from Ohio to get the skill sets that are necessary to do the jobs that are being attracted to Ohio, then I think we have a real chance. But we do need to take some effort to actually do that work. And there's a lot of work going on between businesses now and community colleges and other universities to try to do that work. And I think that's crucially important.
And I would just add that business owners and CEOs should really actively look at internship programs and things to really attract these kids and give them an opportunity. I would encourage everybody to do that. Not that you're here to listen to my answer, but to what extent do the central bankers of other nations typically coordinate with the Federal Reserve in terms of setting interest rates, or are the decisions completely independent and just inform each other?
Yeah, there isn't coordination. There is sharing of information, and sharing of information to sort of understand what's going on in the world economy, the global economy, because that does affect the U.S. And of course, they want to know what's happening in our economy because we're a large global economy. So what happens in the U.S. does affect the rest of the world. But there isn't coordination per se. There's not a, Jay Powell doesn't talk to, you know, the chair of the ECB, you know, and say, okay, I'm going to raise interest rates here, or Andrew, you know, the UK, and say, I'm going to, you know, that doesn't happen. But there is communication because it's better for everyone to sort of understand what's going on in the global economy.
We have time for just two more questions, so we'll get these out there. And one's really a good question. I'll save it for last. How can the Federal Reserve and local government work together in addressing future development in housing?
It's a great question because one of the things that we've seen during this cycle, but it predates this cycle, is there's a real lack of supply of housing. And there's a lack of supply at all income level housing, right? You know, there's affordable housing is not there, but even on up, there's this lack of supply of housing. And of course, housing is incredibly important, right? You know, we have the Intel plant coming, like, do we have the workforce? That's the first question he asked. Do we have places for people to live if we're going to attract these people to the region? So that's an incredibly important thing. I mean, we're doing some work at the Fed to really understand what's happening in the housing market. Our community development staff, we have some experts in housing, and they do things in terms of, we don't collaborate, I would say, with government, but what we do at the Fed is put out objective research that has policy relevance. So for example, we've investigated the zoning issue and sort of understanding whether zoning rules are contributing to some of the issues in the housing market. We understand sort of what's happening on the inflation side, which can prevent, you know, construction from going forward. So that's kind of what our role is at the Fed, is really providing that objective analysis that other people can use in their policy-making role.
Great, thank you. And we have time for one more question. You mentioned that the majority of Ohio industries has transitioned away from manufacturing and toward ed and med. Why do you believe this is the case, and where do you see the manufacturing industry headed?
So I do want to point out one thing, that, you know, the data that we have on those shares, it's employment shares. So as manufacturing has changed, right, from heavy manufacturing to more, I would say, technical manufacturing or different kinds of manufacturing, right? You don't need as many people. It's more productive, right? So it doesn't mean that it's a less important part of the economy in Ohio, but when you're thinking about labor markets, you do have to recognize that where are the jobs going to be? And we've seen this transition. Service, and this is true in most states, right? We've seen a movement from manufacturing and heavy manufacturing in particular to service sector. And that takes different skill sets. It takes different kind of talent. It takes different kind of, it results in different kinds of income growth. And so I think it's something that everyone should recognize that that's going on. But that doesn't mean that manufacturing isn't going to be an important part of the Ohio economy. In fact, regions that have that diversity, right, actually fare much better. And there's a whole body of research that looks at that they're much more resilient. Because we don't know what shocks are going to hit us. I didn't anticipate a pandemic, I'll admit that. But, you know, we had it, and we don't know what the next shock will be. But if you have a diverse economy, you're going to fare better. And so some of what I was trying to say there is we have seen some more diversification, and I think that's good for the region.
Well, thank you, Loretta. That concludes the Q&A. Let's give Loretta a great Wayne County round of applause.
Well, thank you very much. That was an insightful B for B, and we appreciate your time. We want to send you home with some cool stuff that's made in Wayne County. And I will say the Lay's potato chips don't usually last very long in our office, but this is a full bag, I promise. So thank you very much.
Thank you for this.
Thank you. Well, we appreciate all of your attendance today. I have a couple thank yous. Number one, to Clint Sprunger and his team for doing a wonderful job with the live stream and the AV, and also for helping to produce and shoot the Made in Wayne 2.0 video. You got some great footage of manufacturing in Wayne County, and we appreciate that. So thank you, Clint. I also would like to say thank you to Tracy. I don't know where you went, but thank you for all of your help, your creativity, and all of the support in making today's event a success. So thank you to Tracy, and also to Kara, a very valued member of our team. Thank you for your help today, Kara. I would be remiss if I didn't take an opportunity to introduce you to who will be joining our team. Pretty soon, on the 28th, I believe, Amanda Anderson will be joining our team as Director of Business Development and Growth. So we appreciate Amanda and look forward to the contributions that you are sure to make in Wayne County, and we appreciate that. I'd like to thank our economic development partners for their support of our event today from Ashland, Medina, Holmes, and Stark County. We appreciate your partnership and all that you do to make our region so strong. And lastly, I'd like to thank each and every one of you for your attendance today and your support of WEDC. We hope to see you at a future B for B, and we'll be reaching out to let you know what our next topic would be. But thank you, and we hope you enjoy the rest of your afternoon.